Hey, it's Rav, and welcome to the Everyday Investor, the hottest real estate investment show in the world. That's right, I said it. I don't care who knows it. We've got a fantastic show lined up for you. We're going to be talking about how to make money, how to invest in mortgages, getting a great return on investment. Remember, always ask those 4 questions to start whenever you're proposed an investment opportunity. Number 1, what is the ROI, the return on investment? Number 2, when do I get that return on investment? Number 3, what is the investment amount needed? And number 4, what is the risk? We are talking to my good friends, Carmen Campagnaro and Jordan Campagnaro. They're on the show. They're just not only on the show, they sponsor the show. And I first of all want to say to Carmen and Jordan, thank you guys so much for believing in this investment show, for sponsoring it, and it's such a pleasure to be able to have you on here.
Oh, it's an honor.
So
thanks
for being here. If we weren't on TV, I'd come around this table and give you both a big hug and a kiss. But to keep it professional, we'll kind of jump right in.
Okay.
Pro Funds Mortgages, Carmen, and you've been in this this business. We're, as many people think, we're probably twin sisters. But we're actually mother-daughter in this business with an additional staff of,
yes,
what, 20, 30 people? I don't know how many.
40 people now.
About 40 people, really. That's great. In this whole outfit, because we do a lot of different things. But talk just for a second, Carmen, how you got started. Is again, as young as you look, this is maybe 2-3 decades ago?
Well, not 3, but 2.
2
decades.
2 decades ago, you started investing in real estate. So just touch a little bit on that. I mean, I don't know, I think you made 6 figures on your first deal.
Well, yeah, that was when I was 18. I did my first investment, which was great. I mean, it was fortunate because when I invested in the house, I was just at that time between a bubble of real estate and then before it declined. So I ended up making $100,000 on that when I was 18.
At 18 years old.
Yes.
And who helped fund that? Was it a relative that helped you?
Well, my dad and I had some funds, my dad had some funds, and we invested together.
Yes.
So we bought the house, we sold the house. We made, between the 2 of us, we made about, I'd say, $60,000 each.
That's fantastic.
Yeah, so it was about 120.
And I think, Jordan, I think you would agree, it's great too. I mean, this whole world is about mentoring and coaching and being nurtured. What greater mentor, in life, of course, mom. But when it comes to business, you even get mom to be able to help you. What was that like kind of growing up?
Yeah, I've always been kind of surrounded by the industry, even as a little kid. So it's just something I was used to. And when I graduated university, then I started with the company. I started doing summers at the company, and then I started full time when I graduated.
Yeah.
So I've been there for about 4 years now.
So
yeah.
other than associate boss, what is your title at Pro Funds?
So I'm the director of investment operations. I work with our investors in allocating their funds towards certain mortgage investments and projects that we have available.
Yeah.
Very cool. And what I love about it most is, you're a mortgage brokerage like others, except for the fact we don't just do mortgages.
Yeah.
as what Jordan is full-time focused on, investments, right?
Yeah.
I mean, that's one part of it. If I need for my principal residence, if I need money for a mortgage on my principal residence, you do that all day long.
Yep.
But I also have 25, 50, 100 grand, 200 grand that I want to invest. I can, give you guys a call and make significant returns on that.
Yeah, Pro Funds really does cater to investors all around.
Yeah.
So we handle their
Very
financing, unique. We can handle residential mortgages, and we get great rates because of the volume.
Commercial.
We do commercial, we specialize in investor financing.
Yeah.
And along the way, as time went on and the lending criteria became so stringent when the mortgage rules changed in 2008 and then in 10, private money became such a demand, and that's when the company took the step to really focusing the energy on that and helping investors facilitate their deals that way. So it worked out really well.
And you can lend, and people can borrow all across Canada.
Yes, all across Canada.
Yeah.
And
so somebody's watching right now in BC or in Saskatchewan or wherever they are, they can still contact Pro Funds to be able to get help, whether it's principal residence, whether it's investments, whether we want to lend, whether I want to borrow, all those things.
Yeah, we cater to the investors that are on the end that are borrowing.
Yeah.
And the lending. So we put the two together. So when people are lending in our company or through our company, they're dealing with investor type people that are borrowing. So the type of direction to the funds isn't as risky as what you would typically see in the mortgage industry, because they're investors with great credit. We have security on real estate.
Yeah.
So it's a very different animal altogether.
So just to be clear, like I said, conventional mortgages, I need one for my principal residence. I need one, for that's just day-to-day living in terms of buying and selling real estate when most people think of mortgages. But Rav is also an investor. And so I've got $100,000 and I want to put it out there and make money on my money. So I can, through you, lend my money, me being the bank, lend it to somebody else. They may be an investor as well. And I can make money that way. Rav needs to borrow $100,000 because I'm doing this project or I'm doing this or that and I'm going to make a lot of money on that, but I need 100 grand. So I can come to Pro Funds as well and I can borrow money.
Right.
So kind of three-prong approach. Typical mortgage for principal residence, I can lend and I can borrow.
Right, and if you're a builder or developer and you need larger funds, we can facilitate that as well.
And we're going to talk about that, and then you topic that, if you will, in group mortgages, syndicate mortgages, where a bunch of people like Rav, I want to lend. I might not be lending money to just Jim. Rav and friends pool our monies together and lend it to perhaps Jim, the developer.
Right.
Okay.
Absolutely.
So
and the returns are significant.
Yeah, we'll talk about the returns in a second. But this is really what I just really wanted to kind of, hammer down on what we as Pro Funds specialize in.
Yes.
Right. We specialize in just general mortgages, but then we specialize in lending and borrowing from an investor vantage point.
Exactly.
Okay, great.
Exactly.
So talk a little bit about the difference then on this concept of private lending and group lending. So first of all, let me get clear on that. Do we call it group lending or syndicate lending? I mean, does it make it, it's the same thing, right?
It's kind of one and the same. It's ultimately referred to as a syndicate mortgage, and that's when we have two or more parties coming together lending to one mortgage.
Okay.
That's right.
Okay, so what would you say, what's the difference then between private lending, just so we're clear, and syndicate lending?
So, well, private lending is the vehicle itself.
Yeah.
So there's an individual mortgage.
Sorry, individual, that's the
Yes,
terminology.
yes,
Okay.
yes. So private lending is individuals, you and I and everybody out there, lending their money to a group, with a group or an individual.
Yeah.
So individual is basically, let's say you, Rav.
wants to lend money to Jim.
Yes.
Okay.
And it's a mortgage between the two of you.
Okay.
Okay. And then there's our syndicated mortgages, Jordan.
Yeah, and that's when we have, a group of parties that are lending to either one individual, or they could be lending to, larger scale development, construction projects.
Okay, great. And so when Rav, let's just talk about the private individual. What'd you say?
Individual mortgages.
Individual mortgages.
Yes.
So when Rav wants to lend to Jim, individual mortgage, but I don't necessarily, as much as I love people, don't want to know Jim.
Right.
Am I protected? Is that what Pro Funds is kind of the in between?
So how it works is an individual will come to us
Yep.
looking for financing, and we have an underwriting department. So what we do is we'll go through the whole deal,
Yep.
credit.
This
we'll
is
make
Jim. Jim's coming to you.
Jim's coming to Pro Funds and saying, I need a mortgage.
Yep.
Okay, Jim, let's see the appraisal, let's see your credit bureau, let's see why you need the money, and we do our own analysis on the deal.
Yep.
And once we've approved it,
Yeah.
then
Well,
we
that's
send.
great. So you've done all the vetting.
We have now. You as a lender.
Of course, I still got to do my
You
due
need to make
diligence.
sure you're feeling comfortable with it because it is your investment.
Yeah.
The money doesn't come to Pro Funds; it goes directly to the borrower through a lawyer.
Yeah.
So this is always closed through a law
So
firm.
Rav's going to lend that $100,000 through a lawyer.
Yep.
Who pays for those lawyers' fees?
The borrower.
Jim's paying for
It
the
costs
lawyer
you
fee.
nothing,
It
Rav.
costs me nothing.
Right? So
Yeah.
we don't charge you a management fee or an asset management fee or anything like that. The borrower will pay you.
But how does Pro Funds eat then?
Pro Funds will charge
The
the person
borrower.
borrowing
Okay, great.
a fee
Yeah.
for providing all of this.
As they should.
Yeah, and they'll also pay for your legal fees, their legal fees, and they'll also pay you something we call a lender fee.
Yeah.
So it's not a fee to you, it's a fee to the borrower. And then they pay interest as well on the money, and it's typically an interest-only loan.
Yeah.
And 1 year, 2-year terms. And also, when we do offer the returns, they're fixed returns. So a first mortgage would go anywhere from, let's say, 7 to 11% interest only,
Yeah.
paid monthly.
Yeah.
And then a second mortgage would go anywhere between, let's say, let's say 10 and 16% interest.
Wow.
Interest only.
That's
paid
how much money
monthly.
I can make on my
Yes,
100 grand.
correct.
Wow.
Yeah, it's amazing.
Okay, you know what? Let's cut to a break here for just a second. When we come back, let's talk more about the numbers. Did I tell you I'm so grateful that you guys are on the show?
I know, it's
Thanks,
great.
thanks for being here.
Oh, thanks so
We're
much.
talking to Carmen, we're talking to Jordan, we're learning how to make money investing in mortgages. You don't want to miss this show. The Everyday Investor continues in a moment. Hey, it's Rob. Welcome back to the Everyday Investor. We're talking to my good friends Carmen and Jordan about how to make money investing in mortgages. The Pro Funds gals, thanks so much for being here. When we just before break, we talked about the individual mortgage, and so Rav's going to lend money to Jim, $100,000, and I can enjoy a return, get my 100 back, and make anywhere from $8,000 to $16,000, 8 to 16% on that individual mortgage.
That's
Yeah,
right.
and when that party invests, they're actually registered on the borrower's on real estate. So they're actually registered
That's
in
my security.
Yeah, as
So
a
I get to
mortgage.
put a registration or a lien or a blemish or
Charge.
something, a charge to protect me, because I'm not going to lend to Jim unless I know there's some sort of collateral there.
Exactly.
And if anything were to happen, I'm good. You
That's
know?
right.
And,
Well-
and it's up to, I mean, it's up to me to figure out, is it enough to decide, is it enough collateral for me to feel comfortable? If it's not, then we move on and we find another person that needs Rav's money.
Yeah.
Correct?
Yeah, so a mortgage actually is a registered charge. So if you were lending $100,000,
Yeah.
a lawyer would be involved and he would register a charge or a lien in sort of say
Yeah.
on the property, just like a bank does. And people are starting to hear about this, and because there's security on real estate, your returns are significant. If they're short term, they're fixed returns.
And somebody like Rav, Carmen, may have $100,000, but it's in RSPs or it's in RESPs. I'm not really making any money. We can use registered funds.
Yes. So we do accept cash investments as well as registered funds. So RSP, TFSA, LIRA, all of those are eligible. They
Yeah.
just have to be moved over to basically a holding institution that's going to allow you to self-direct into mortgages.
But you walk me
And
through all that.
That's something that Pro Funds does assist with.
Yeah, and then there's no tax consequences because my ROI, my return on investment, goes right back into
the plan.
the RSP or
Yep.
RESP, TFSA.
Yep, so you're not penalized for putting the funds into an investment vehicle like this.
Yeah.
And the funds always go directly back into the plan. So your plan grows and you're not being taxed on it. So that's the benefit of RSP
But
lending.
8 to 16%. I mean,
It's
that's
real.
that's
yeah.
fantastic.
And
So
those
that-
are fixed returns.
fixed
so-
returns.
Yes.
So that's the individual mortgage.
Yes.
So let's talk about the syndicate mortgage and how does it differ, and let's talk about the returns on that. And yeah,
So an individual, I'll let Jordan speak on syndicate because she's dealing a lot with that.
Okay.
But on the individual mortgages, you're dealing with a party outside, a third party. So it's you and Jim,
yeah,
for example.
me and Jim.
Okay.
But I'm not necessarily talking to Jim.
No,
I go through the lawyer.
Yeah,
I
Pro
go
Funds
through-
goes through the whole process of sending you the deal.
Yeah.
You approve it. You want an appraisal. You want any other information, we'll get that for you.
Yep.
When you're comfortable, we draft the paperwork. It goes to the law firm,
Yeah.
and then he registers a charge. You get 12 post-dated checks. You deposit the funds into your account every month, and everyone's happy. At the end of the term, we ask if you want to refinance, stay with this investment, or if you want to be paid out. That's your choice, and then we arrange for all of that.
And is it for anybody? Like, is there any kind of restrictions on who can do this?
No,
is there
there's
any kind
no
of eligible?
limit.
There's
No, it's
There's
not
no
like
eligibility requirements.
This doesn't fall under the Canadian Securities Commission,
No.
because then there's you have to get qualified. You have to have certain net worth.
No.
Here,
No,
anybody can.
we want to make sure we know our clients, and we do go through a process like that so that we know that we're not dealing with, someone elderly that's got their last $20,000, and
sure.
there is some risk, and we can talk about that.
Yeah.
But we want to make sure that the person is suited for the investment. That's important for us.
They also need to meet a minimum investment that's set.
Well, I was
It's
gonna ask
typically
that.
50,000 per
50,000
investment.
typically. I mean, there's some exceptions with some deals that are
Yes.
that's slightly lower, perhaps.
Yes,
But
exactly.
so the first question on individual mortgage: what's the return on our investment? Anywhere from 8 to 16%.
Correct.
When do I get that back? Like, how long are these terms?
So it's typically on individual mortgages, they're 1 year.
1 year.
1 year
So I get
terms.
my principal back plus 18 to 16%.
Yeah, so it's an interest-only payment that you get monthly, typically.
I get paid monthly.
And then at the end of the term, when the mortgage is matured,
Yeah.
you get your principal, which
Yeah.
is, in this case, we're talking about $100,000,
$100,000, yeah.
comes back to you. So you, over the term, have earned your 16 or 8 to 16%.
Yeah.
And then you get your $100,000 back at the end
And
of the
then
term.
the minimum investment we just talked about, generally about $50,000.
Yeah, sometimes we have $25,000 investments that come on the individual side.
Yeah.
But then on the syndicated mortgages or the group
Yeah.
or project lending in most cases, and that's a whole different topic.
Yeah, that's
So-
when we're
so-
dealing with a much larger loan amount. Typically, we're funding development and construction projects. So
Yeah.
for that, the minimum imposed is
$50,000.
50,000.
Because the developer doesn't need $100,000. They're usually $2-3 million or more,
Yes.
you know, that kind
Up
of thing.
to-
Yes.
So before we touch on the syndicate, on the risk side of what would be any risks on the individual RAV lending to Jim?
Right. Well, the most important part is something called loan to value, which is your loan amount or the total loan amount that we're lending to this person
Yeah.
versus the value of that property.
Okay.
Okay, so we really like to go 80, 85. The market's been very, very hot.
So when you say 80, 85, that means that there's 15 to 20% of equity
Correct.
in that property.
That's right.
Okay.
That's right. So maximum 80, 85.
And
Okay.
we do see much lower. I mean, depending on the
60.
deal, it can be a range between 50 to
Yeah.
80, 85.
But when
Yes.
there's more equity in the property, when the lending loan to value is lower, then the returns are probably going to be lower because
Correct.
it's
Yes.
safer.
Absolutely.
For lack of a better word. If it's 85%, then maybe that's where I can enjoy the 14, 15, 16% return.
That's correct.
Absolutely.
And that's
Yep.
up to me to decide.
Exactly. So if you
This
feel
is not a
comfortable with
fund,
that,
even though we're pro funds.
Yes.
This particular vehicle is not a fund. It's lending specific.
right.
I could be doing lending to Jim, or I can be lending to John, or to
Correct.
Nancy, or whatever.
And it is a third party, and you know it's beyond our control what these people do, right?
yeah.
So if they decide not to make their mortgage payment, then we have to deal with a default. Now you have security or register on the property, but there's a process to go
Sure.
through to recoup your investment.
Okay.
Okay, and we participate strongly in that. Our investors are our priority.
Yeah.
So we.
Well, I know some of your investors, and I know
Yes.
that they've exited, and
Yeah.
they continue to invest with you again.
Yeah, we haven't
because
had
they're
anyone
enjoying-
lose money.
Yeah.
And we're really particular about that.
Selective
Yeah.
the deals that we
Yeah.
decide.
Well, you're not a small operation, right? So
No,
it's a
yeah,
big, and so
it's
the
grown.
bigger we get, the more we have to dot our I's and cross our T's,
Absolutely.
because just
And
a little bit of,
Our investors are first priority. What we make is second. So, and that's our model. That's how we work, and that's how we've always worked.
Yeah.
And I think that's what's created the success for the company.
yeah.
But we should talk about the syndicates
Let's talk about
because
syndicate mortgages.
this is a really great part. And
So Rav and a whole bunch of other people that I don't necessarily know, we're
Exactly.
going to lend to, let's just say, Jim the developer. And Jim
Exactly.
the developer needs $3, $4, $5 million?
Sure,
million?
yeah.
$10 million?
20 million. We've done kind of a range between usually smaller to mid-scale development
is a
projects.
sweet spot. We're not
Yeah.
really into the 100 million. We like to do anything from, let's say, 2 to 20.
Okay, so cover those questions then. What can I enjoy in terms of a return? When do I get that return? We talked about already the minimum investments, 50,000 or more, depending on the project. So what kind of return can I expect, and when would I get that?
So the returns for the projects typically are between about 12 and up to 16% per year.
Okay.
And they're usually broken down the way that the investor would receive the interest would be broken down into a couple different components. So
Okay.
there's the lender fee,
Yeah.
that's fixed. You're going to get that at the end of the term when you got your original investment back.
Okay.
And then there's the interest rate, and that you can either get monthly, so it would actually be by auto deposit into your bank account.
Just like the individual mortgage?
Just like the individual,
Yeah.
or in a lot of the cases, you can actually get a lump sum or a prepaid interest. So you can elect to receive
Like right up
interest.
front.
Yeah, so 1 or
Yes.
2 years in advance, you can get that right on day one and be able to leverage that prepaid interest and invest in other avenues.
So
And
the
then that would
return is
change,
even
I was
higher.
going to just say that. That would change the ROI.
So it would increase
Yeah.
the ROI.
That would change the ROI. Okay, and the typical time frame on these kind of projects?
So they range. It depends in what timeline we're getting involved in this development, anywhere between 1 to 3 years. They do
Yeah.
tend to go a little bit longer than the individual mortgages
well, you're
because we're
building something.
more complex.
Yeah. So if it was 3 years and I get 8% fixed per year.
Yes.
So every year, let's use the 100,000 again. So I'm getting $8,000 divided by 12 months, so like $700 and change per month
Or you can choose to take it all up front.
No, but the first option, right? $700
right.
or so per
Yep.
month for 3 years.
Yes.
That's right.
Then after that 3 years, I get my $100,000 back, my original principal, plus I get a lender fee.
Exactly.
And that usually is around.
So it's usually divided equally. So if the interest rate is 8, it may be anywhere between 5 to 8%. It's usually kind of split in half between the interest
Per year.
and the lender fee.
Yes.
So if it was 5%, at the end of 3 years, I'm getting 15%. I'm getting another $15,000.
Yes,
That's
and there aren't any contingencies on receiving that.
Okay.
So it's not
it's not about the profit of what the developer makes.
it has nothing to do with profit. It is a registered
Fixed
mortgage.
contractual return.
Yes.
Got
The
it.
other benefit of the syndicated mortgage with our company specific is that we have a sister company called Valor Capital.
Valor Capital.
And Valor Capital basically is the development division, and it's a group of companies.
Okay.
And that company has an interest in the projects. So that company
So ProFunds also has interest. They want to make sure that this project does well.
it comes to completion.
Yeah.
We sell it out. We have
We have a team of analysts as well that do all of the due diligence for these projects
Yeah.
and to make sure that they're vetted 100% before we decide to proceed with them.
Yes.
Okay.
And then so the company is actually rewarded at the end rather than up front. I mean,
Yeah.
there are fees up front.
Yeah.
However, the big bang is at the end.
Yeah.
So there's huge motivation, A, to protect our investors,
Yeah.
and B, that's to make sure that the project comes to fruition at the end.
Yeah, I mean, it's why the banks are in business, right? They lend, they lend, they lend, they lend. Why can't RAV be the bank? And why can't RAV lend to Jim or Jim the developer, And why
It's
can't...
been around for decades. This is not a new vehicle.
Yeah.
It's just people are starting to hear about it.
Yeah.
So there's a lot of money to be made in that industry.
Yeah. No, it's
wonderful.
fantastic, and time flies when you're having a good time learning about all this. We're going to take a break and just come back, Carmen, with your closing thoughts.
Absolutely.
We've been talking to Carmen Jordan, learning how to make money investing in mortgages. When we come back, we'll hear from Carmen and just her closing thoughts on this whole world of real estate investment. Thanks for watching. Hey, it's Raph. Thanks for watching The Everyday Investor. It's been a fantastic show talking about how to make money investing in real estate. Carmen and Jordan are with us here today. Carmen, thanks so much for being on the show.
Thanks,
Jordan, you as well.
Thanks, Raph.
Just your kind of closing thoughts from a maternal point of view, from a business point of view, to the viewers at home when it comes to this whole concept of investing in real estate, specifically mortgages.
Well, I think that people need to know that it's not just geared to people that are already financially stable. It can cater to new investors with, let's say, some equity in your home. It can cater to younger people, middle age, and even seniors. We have a lot of elderly people doing this, and it's definitely assisting them with their retirement years.
Well, especially if you can do this with 1 year terms. It's not like you're into something for 5, 6, 7 years, right?
I have so many people right now refinancing with these low rates, taking the equity they have in their home, and the mortgage investment actually pays their mortgage payment and gives them X amount of dollars of positive cash flow every month.
Cash flow that
It's
they can
amazing.
now use and to live off of.
Well, they're making the margin, right? So their interest rate on their home equity line of credit may be 3% or so, but they're making 12%. So they're making 9%.
Yeah, and it covers their mortgage debt, and then they have, I have many clients that have refinanced, lent the money. Now they're getting cash flow every month, and their whole lifestyle has changed.
Yeah.
It's really been really good for them.
Yeah, and not necessarily home equity line of credit. There's a lot of people who have 50 grand sitting in a registered fund that's not making them money. Why not enjoy 8 to 12, 16% doing that as well?
Absolutely. It's been wonderful.
Listen, guys, thank you so much for being on the show, Carmen. A pleasure.
Thank you.
Jordan, there we go. It's been a pleasure. Thank you so much for being here. And
Thanks.
thank you, viewers at home, for watching this show. To learn more about how you can become an everyday investor, follow us on social media, including Facebook, Instagram, Twitter, or you can connect with us at theeverydayinvestor.tv. Till next time, this is Rav saying thanks for watching, honey. I love you. I'll be home soon.